Will, Wall Street just gave us the most dramatic AI story of the year. A 24-year-old former OpenAI researcher built one of the hottest hedge funds in America. At its peak, reports valued the fund at roughly $45 billion.
Wealth isn't disappearing. It's changing hands.
The next 10 years won't reward hustle. They'll reward better decisions. I'm Chi-Chi, tracking capital before it trends.
I'm Will, 20 years navigating real market cycles. The edge today isn't more information. It's sharper judgment. This is Align Wealth 2040.
Clarity,
Strategy.
action.
Then, the AI trade cracked, margin calls arrived, and Ken Griffin's Citadel came in to buy much of the portfolio.
This story has everything Wall Street loves: a young genius, an unstoppable technology, enormous profits, extreme leverage, and an old fox waiting for the moment when brilliance runs out of cash.
The young investor is Leopold Aschenbrenner. He finished college at 15, worked at OpenAI, and wrote a viral essay called Situational Awareness. Then he used the same name for his hedge fund.
For a while, the name seemed perfect. He believed the AI boom would require far more chips, memory, electricity, and data centers. His fund concentrated money in companies tied to that build-out, including SK Hynix, SanDisk, CoreWeave, Bloom Energy, and other AI infrastructure names.
And the thesis worked spectacularly, until it didn't.
Exactly. The fund reportedly gained more than 400% in the first half of the year. Success attracted more capital, and leverage magnified the results. But concentration plus leverage is a machine that runs in both directions.
When AI stocks sold off, the fund lost about 67% in July. Prime brokers demanded more collateral, forcing the fund to raise cash quickly. Reuters reported that it sold most of a roughly $16 billion public equity book, with Citadel buying a large portion.
The fund removed its leverage and retained about $10 billion in assets, including valuable private investments such as Anthropic. So this was not a total bankruptcy, but it came dangerously close to permanent capital impairment.
That distinction matters. Social media says $45 billion vanished overnight. The verified story is more nuanced. But the lesson is just as powerful. You can be right about the future and still get destroyed by the structure of your trade.
That is the real headline. Leopold may still be right that AI will transform the economy. His mistake was not necessarily the AI thesis. It was turning a long-term thesis into a concentrated, leveraged position that could not survive a short-term storm.
And then Ken Griffin appeared.
Ken Griffin did not need to prove that Leopold was wrong about AI. Citadel only needed liquidity when Leopold did not have it. Griffin's team reportedly analyzed the book overnight and bought distressed positions after margin pressure had weakened the seller's bargaining power.
That sounds less like forecasting and more like hunting.
Welcome to Wall Street. The street first manufactures a hero. Extraordinary returns become a genius narrative. Capital floods in. Risk controls begin to look old-fashioned. Then volatility arrives, lenders call, and the same system that crowned the genius forces him to sell to the strongest balance sheet in the room.
So Wall Street creates heroes and then tears them down.
Yes, Ken Griffin has seen this movie before. Citadel has bought or supported distressed portfolios during crises involving Amaranth, SoWood, Enron-related positions, and Melvin Capital. The pattern is simple. The young star owns the exciting story. The old fox owns liquidity, risk systems, and time.
That explains why Citadel could buy while everyone else was selling. It was not merely smarter, it had designed itself to survive.
Survival is the most underrated investment edge. If you use 4 times leverage, a 25% decline can theoretically erase your equity before recovery arrives. Your thesis can be proven correct next year, but your broker can liquidate you today.
Jeremy Grantham has been warning that the greatest technologies often create the greatest bubbles. Railroads were real, the internet was real, AI is real, but real revolutions attract too much capital, too quickly, at prices that assume perfection.
Exactly. Grantham may be right about excess valuations. Big tech is spending extraordinary amounts on chips and data centers. I call it compute inflation. Microsoft, Meta, Amazon, and Google cannot stop spending without risking their competitive position. But spending more does not guarantee that AI revenue will arrive fast enough.
Still, today is not identical to the dot-com bubble. Microsoft, Google, Meta, Amazon, and Nvidia generate real profits and enormous cash flow. They may fall 30 or 40%, but they are not empty websites selling a dream.
Which is why ordinary investors should avoid two emotional extremes. Do not assume every AI stock can only go up, but do not hear one hedge fund blow up and sell every American stock tomorrow.
Then what should regular people actually own?
Start with a core, not a casino. For long-term money, a broad index such as the S&P 500 or a total market fund gives exposure to AI winners without making your retirement depend on one company. The index will rebalance over time, weaker companies lose influence, and new leaders enter.
But the S&P 500 itself is concentrated in mega-cap technology.
True. Investors who want more balance can combine a broad market core with value, equal weight, dividend, international, or small-cap exposure. Diversification does not eliminate bear markets, but it prevents one brilliant story from becoming your entire financial life.
And if someone strongly believes in AI?
Use a satellite position, perhaps a limited allocation to AI infrastructure, semiconductors, or selected leaders, an amount that can fall 50% without changing your retirement date. No margin, no money needed for rent, tuition, or the next 3 years of living expenses.
In other words, conviction needs a position size limit.
Yes, then build a liquidity layer with cash, treasury bills, or short-term bond funds. Cash may look boring during a boom, but liquidity gives you choices during a crash. Ken Griffin did not win this trade because cash was exciting. He won because cash became power when someone else faced a deadline.
What changes for investors over 40, especially those approaching retirement?
They face sequence of returns risk. If the market falls sharply while you are withdrawing money, selling shares at depressed prices can permanently damage the portfolio. That is why some investors add a risk-controlled layer rather than choosing between 100% stocks and 100% cash.
One tool that may help people navigate sequence of returns risk is a RILA, or Registered Index-Linked Annuity.
A RILA can link returns to an index such as the S&P 500 while using a buffer or floor to define part of the downside. For example, with a 10% buffer, if the index falls 15% over the measurement period, the contract may absorb the first 10% and the investor takes the remaining 5%.
A floor works differently. A negative 10% floor generally limits the index-linked loss to 10%, even if the index falls more during that term.
But protection is never free. The contract may cap gains or apply a participation rate. It may exclude dividends, restrict liquidity, and impose surrender charges for early withdrawals. Guarantees depend on the insurer's claims-paying ability. A RILA is not a savings account, and it is not right for everyone.
So where could it fit?
Give different dollars different jobs. Long-horizon growth money can remain in diversified equities. Near-term spending belongs in cash or short-term treasuries. A portion of longer-term retirement money, especially for someone who wants index-linked growth but cannot emotionally or financially tolerate the full market decline, may be considered for a carefully selected RILA.
That is a very different mindset from asking, which AI stock will make me rich?
It is the difference between building wealth and auditioning to become Wall Street's next hero. Heroes concentrate on being right. Survivors prepare for being early, being wrong, or simply being unable to control the timing.
Leopold's story is not proof that AI is over. It is proof that intelligence does not cancel leverage, and a great thesis does not replace liquidity.
Ken Griffin's edge was not a magical prediction. It was the ability to wait until a forced seller appeared. The old fox understood the first law of markets. Assets do not always move from the foolish to the wise. During a crisis, they often move from the leveraged to the liquid.
For ordinary investors, the answer is not to become Ken Griffin or Leopold Aschenbrenner. Own a diversified core. Keep AI exposure sized appropriately. Maintain cash. Avoid leverage you cannot control. And as retirement gets closer, consider whether a defined risk tool such as a RILA belongs in one part of the plan.
Wall Street will keep creating new heroes. It will keep destroying them too. Your job is not to worship either side.
Your job is to make sure your financial future survives the entire cycle.
If you're thinking about your family's future, income, education, retirement, and feel overwhelmed by information, that's normal.
Real confidence doesn't come from more opinions. It comes from a clear structure and a plan you can execute.
That's why we offer a complimentary 1-1 strategy session focused on your specific situation.
Some families refine their financial strategy. Others explore partnership or even a path to grow with our team. The link is below. Align Wealth 2040. Build with intention.